When the Delta variant struck, much more aggressive, and so the authorities had to take stronger action and lock down the key cities of Hanoi and Ho Chi Minh City and some of the manufacturing areas. So that has had a knock-on effect, and there's certainly been delays to some production.
There's one topic that can currently not be avoided when talking about the capital markets: China and its common prosperity. Even so, emerging markets appear to have the highest earnings potential, and therefore I'm talking to Greg Martin today, Chairman of Dynam Capital. Thank you for coming to our Cologne offices today to have a chat about Vietnam with me.
My pleasure, lovely to be here.
When we met 2 years ago in Zurich, we were talking about what happens when complications arise in China, and you mentioned that Vietnam would be one of the winners in a situation like this. What's happened over the past 2 years in Vietnam, and how has it performed?
Well, back then, I think we said Vietnam will be a trade war winner. So if you remember at that time, you had the US and China battling to see who's going to be the biggest on the block. And Vietnam very cleverly saying, I don't mind who's going to be biggest. I don't need to be the biggest. I want to trade with everyone. So Vietnam's got a very open trade policy. And because of that trade battle between the US and China, lots more people look to buy from Vietnam. So its exports to the US go up significantly. Its exports to other countries go up significantly. It attracted manufacturers to relocate some or all from China to Vietnam. And as a result, it's benefited. It's been that trade war winner. Its exports per capita are ahead of China. It's $2,700 versus China's $1,700 per capita. So it's been that trade war winner. What we didn't realize, we're going into a pandemic, and it was a pandemic winner, at least for the first wave.
Can we also talk about the drivers of the good performance of the capital markets or the equity markets in Vietnam?
Yeah, so generally Vietnam has three main drivers that we see. One is this industrialization growth. So this is a multi-year program of building capacity to manufacture for export. Now, we tend not to invest in the exporters per se, but in the business-to-business linkages. The other key driver is the urbanization. Vietnam still only has, say, 36% urbanization rate, which is Germany after the Second World War. And so there's a lot more to come in terms of housing and schooling and modern trade. And then the third key driver is that domestic consumer, which has already passed $3,000 per capita GDP, where people start to spend more. And then as those consumers become digitally enabled, you're seeing a growth in e-commerce. And so Vietnam's on this journey to be a digital economy by 2025. So all of these have been playing out. And also the financial services has been a big growth engine as well, the banks particular. So we've seen many of those sectors deliver mouth-watering returns. Some of our portfolio companies, more than 100% return over the last year. So it's being clever about good sectors, but also which companies you want to allocate the portfolio to.
When we look at the news over the past couple of days and weeks, we hear a lot about the delivery bottlenecks that exist through strict corona policies in Vietnam and due to factories having to be closed. Is that just one of the risks you take as an investor when investing in a country such as Vietnam?
Well, I don't think anyone got COVID right. Vietnam was that pandemic winner in the first wave, so a very strict control policy that worked well for the early waves. When the Delta variant struck, much more aggressive, and so the authorities had to take stronger action and lock down the key cities of Hanoi and Ho Chi Minh City and some of the manufacturing areas. So that has had a knock-on effect, and there's certainly been delays to some production. I think it's affected more in the footwear and the fashion, where Vietnam is maybe 40–50% of global production. And some of those manufacturers might allocate some portion of their orders to other countries. That's not uncommon. But I think more importantly for Vietnam is that the existing large foreign direct investors in the high-tech areas are doubling down. They want to increase their investment in Vietnam. So the likes of Intel or Samsung or LG or Foxconn are looking to do more there. So I think, yes, Q3 and Q4 will be a little bit weaker this year as a consequence of those lockdowns. But that long-term trend of Vietnam attracting record levels of foreign direct investment are set to continue.
You've now spoken about companies like Samsung and LG, and you yourself, you manage a fund Vietnam Holding, a closed-ended fund. What are the prospects and what are the sectors you're looking out for at the moment to invest in to have this added value for your fund and your investors?
Well, it's a good point. It's been a record year for us and for the funds we manage. Our fund is the top performing fund this year, beating the index and the other investors, driven by being nimble around stock selection, portfolio construction. So we've seen the banks, for example, last year be tremendous growth drivers for our portfolio, but maybe not now for the next 3 to 6 months. So by being nimble and looking at some of the other areas, we're able to protect and grow value. We think next year, EPS growth across our portfolio will be about 25 to 30%. And so we're very confident that we'll continue to see the growth in our portfolio. Maybe not to the levels we saw this year, where we've seen such significant growth, and third quarter, fourth quarter might take a little bit of a breather. But by building a portfolio of these great companies, category champions, and being nimble around our allocation, we're set for future growth over the next 2 to 3 years.
One topic that is very big over here in Europe is the topic of ESG. Do you have an ESG overlay and strategy within your fund?
Yes, well, our fund was one of the very earliest adopters of ESG in Vietnam. 10 years ago, it signed up to the United Nations Principles for Responsible Investing. And so we've been very diligent around our responsible investing mandate. Last year, we got top scores. We were A-star, A and an A, fantastic results. We also go further and deeper. We want to do more, we want to measure more, and we want to report more. So we've been looking at our carbon footprint of our portfolio. This year's a big climate year, right, with COP26 in the UK. So we've analysed our portfolio, and over the last 2 years, our carbon footprint is 35% lower than a passive index or an ETF. So by being active in our portfolio construction and our stock selection, we've driven fantastic financial returns, top performing fund, up 47% this year. But we've also been able to position the portfolio around the better companies on the dimensions of ESG. So we're very pleased with both sets of returns and results for this year.
Thank you for visiting us here in Cologne, and thank you for the great insights.
My pleasure. Thank you so much.